Something strange is happening in the market right now. Chip stocks are getting hammered. Gold and the miners just took a real hit. And most people are watching their portfolios turn red and instinctively pulling back, waiting for things to feel safe again before they buy anything. But a handful of patient investors are doing the exact opposite this month, quietly adding to positions while everyone else is glued to the headlines. And by the end of this video, you'll understand exactly why they're doing it and whether you should be doing it too. Before we get into it, if this is your first time here, go ahead and hit that subscribe button on TickerHawk. Every week, I dig into where money is quietly moving before it becomes obvious to everyone else, so you don't want to miss what's coming next. Now let's get into today's 4 names. Here's something worth sitting with for a second. A stock can drop 5% in a single afternoon over nothing more than a headline, a rumor, or a nervous algorithm reacting to a single word in an earnings call. The actual business behind that ticker almost never changes that fast. Revenue doesn't fall 5% because of a bad news cycle. Customers don't cancel their contracts overnight because a stock had a rough Tuesday. That gap between how a stock trades in the short run and what the underlying business is actually worth over the long run is where real opportunity tends to hide. And right now, across 4 very different corners of the market, I believe that gap has opened up wide enough to matter. This isn't about calling a bottom or guessing where the market goes next week. It's about recognizing when good businesses are trading at prices that don't match their long-term trajectory and positioning yourself before that gap closes again. And right now, the gap is showing up most clearly in semiconductors. The chip sector as a whole has slipped into correction territory this year, even while the broader market has held up reasonably well. That's an unusual split, and it tells you something important. This isn't a story about the entire economy falling apart. It's a story about one specific, powerful long-term trend getting temporarily repriced because of short-term nerves. History tends to reward the investors who can tell the difference between the two, and that's exactly the lens I want to apply to today's 4 names. Let's start with the name that might genuinely surprise you, because it's not even a stock. It's an ETF, ticker GDX, and it gives you exposure to a basket of the world's largest gold mining companies all in one position. Gold and the miners have had a rough stretch lately after an incredible run. GDX was trading above $117 back in the spring, and as of this week, it's sitting closer to the mid-70s, which is a serious correction from those highs, not some minor dip. Now, a lot of investors treat gold as an afterthought, something you only think about once the market is already falling apart and panic has set in. I look at it differently. Interest rates are still elevated right now, and that's taken some shine off the metal compared to last year, when rates were lower and gold was the trade everybody wanted in on. But I don't think that dynamic holds forever. If rates start easing in the back half of this year, the way many economists expect, gold and the miners that pull it out of the ground tend to respond quickly, sometimes faster than almost any other asset class. On top of that, I still believe inflation is going to prove stickier than the market is currently pricing in, and geopolitical tension hasn't exactly been fading this year either. Those are exactly the conditions precious metals tend to thrive in. What I particularly like about GDX, as opposed to picking one individual mining stock, is diversification. You're not betting the farm on a single company hitting its production targets, dealing with a mine shutdown, or missing guidance on costs. You're spreading that risk across dozens of miners at once, so a rough quarter from any single name doesn't sink your entire position. This is a name built specifically for uncertain environments, and after a correction of this size, I think patient investors are effectively getting paid to wait around for the next leg higher. And here's the part people forget when gold goes quiet for a while. It's not designed to be the exciting part of your portfolio. It's designed to be the part that holds up when everything else is falling apart. The part that zigs when your growth stocks zag. Investors who ignored gold entirely over the last few years missed one of the strongest runs the metal has had in decades, and I don't want to make that same mistake twice by ignoring the miners just because they've cooled off for a few months. Drop a comment and let me know if precious metals have a place in your portfolio right now, because I'd genuinely like to know how many of you are already positioned here versus sitting on the sidelines. Stock number 2 on today's list is the one that splits opinion more than almost anything else I cover on this channel, and that's Palantir, ticker PLTR. People either think this company is wildly overvalued and destined for a painful reset, or they think it's quietly building one of the most important software businesses on the entire planet. I'll be honest with you, I understand both arguments, and I don't think either side is being unreasonable. But here's what keeps bringing me back to it every single time. This isn't a company that's just talking about artificial intelligence in a slide deck to impress investors. It's a business that's actually embedding AI into how hospitals run their operations day to day, how governments plan complex logistics, and how enterprises make real decisions in real time using real data. That's a meaningfully different story than most of the AI hype you'll find scattered across the rest of the market right now. Shares have been beaten down badly this year, down somewhere in the neighborhood of 30% from where they started 2026, largely dragged down alongside the broader software sell-off earlier in the year rather than anything specific to the company itself. And yet, if you actually look under the hood, the underlying numbers keep improving quarter after quarter. Revenue growth has stayed well above 70%. Commercial customers keep expanding the size of their contracts rather than shrinking them, and government demand hasn't slowed down even a little bit. Wall Street's average price target still sits meaningfully above where the stock trades today, implying real upside from here if the company simply keeps executing the way it has been all year. Now, I'll be straight with you. This is not a stock I would ever suggest. Betting the whole portfolio on, the valuation remains rich even after this pullback, and there are going to be volatile days ahead, maybe even volatile weeks. But for investors willing to hold through the noise and stomach some swings along the way, a pullback of this size on a business still growing this fast doesn't come around very often. Think about it this way. A hospital system trying to coordinate patient data across a dozen departments, or a government agency trying to plan logistics during an actual crisis, isn't going to rip out its entire operating system every time a stock has a rough quarter. Once this kind of software gets embedded into how an organization actually functions day to day, it tends to stay embedded, and that stickiness is part of why the growth numbers keep holding up even when the stock price hasn't. If you're on the fence about Palantir, let me know in the comments exactly what's holding you back, because I genuinely read every single one of them, and it helps me shape future videos. Now let's talk about stock number 3, and this is where we head back into semiconductors with Qualcomm, ticker QCOM. Most people still think of this company purely as the smartphone chip business, and for years that reputation was completely fair. It isn't the full picture anymore, and I think a lot of investors are sleeping on how much the story has changed. Qualcomm recently used its investor day to lay out a much bigger vision for where the company is headed, one that includes automotive chips, edge AI, connectivity solutions, across countless devices, and a genuine serious push into data centers. That last piece is the one I find most interesting, personally. Instead of every single AI task being processed somewhere far away in a massive cloud data center, more and more of that intelligence is going to move directly onto the device sitting in your hand, built into your car, or humming away on your desk. Qualcomm has spent decades perfecting how to squeeze serious computing power out of a small, power-efficient chip, and that hard-earned expertise puts them in a genuinely strong position as AI spreads beyond just the giant hyperscalers and into billions of everyday devices. And it's not just a future promise either. The automotive side of this business has already crossed over $1 billion in quarterly revenue, growing nearly 40% year over year, which tells you this diversification story is showing up in the actual financial statements right now, not just in a forward-looking slide from management. The stock has been genuinely volatile lately, swinging on almost every headline about Chinese smartphone demand and every fresh analyst note that crosses the wire. One firm just reiterated a street-high price target near $300, while another opened a short-term downside watch during that exact same week. That kind of open disagreement among professional analysts usually means the next earnings report is going to matter quite a lot, and Qualcomm's next print is coming up soon. The average analyst target still points to solid double-digit upside from where shares sit today. And for investors who want real AI exposure without paying Nvidia-style prices for it, this is a name absolutely worth having on your radar heading into the second half of the year. Go ahead and smash that like button. If you're finding this breakdown useful so far, it genuinely helps this channel reach more investors just like you. And that brings us to the final name on today's list, the one I've been saving for last on purpose. Nvidia, ticker NVDA. I know the objections already, because I hear them constantly in the comments section. Competition is heating up from other chip makers trying to close the gap. Some of Nvidia's biggest customers are quietly building their own custom silicon behind the scenes to reduce their reliance on outside suppliers. Those are fair points, all of them, and I'm not going to pretend they don't matter. But I keep coming back to one simple question before I make any decision on this stock, and it's the same question I'd encourage you to ask about any position you're holding. Has the actual investment case changed? And every single time I look at the numbers, the answer keeps coming back, no. Demand for Nvidia's chips still massively outpaces what the company is even capable of producing right now. We are still in the early stages of this AI infrastructure build-out, not the late stages like some headlines want you to believe. The biggest technology companies in the world are increasing their spending plans heading into the back half of this year, not cutting them the way you might expect if this cycle were actually slowing down. Despite all of that strength, shares of Nvidia have actually underperformed the broader market this year, which tells you the stock price simply hasn't caught up yet to the growth the business has already quietly delivered. Revenue grew well north of 60% in the most recent fiscal year, and earnings grew even faster than that, which is exactly how a stock becomes cheaper on paper, even while the share price is climbing higher. Wall Street's average price target implies somewhere around 45% upside from where shares trade today, and the overwhelming majority of analysts covering this stock still rate it a strong buy without hesitation. When you look a couple of years further out on the calendar, the valuation on this business starts looking almost inexpensive for a company still growing at this pace. This is the kind of setup that doesn't show up very often in a name this large, and I don't personally think it stays this cheap for very long once the broader market catches on. With the next earnings report on the calendar for late summer, I'd expect any update on chip supply, hyperscaler spending, or new custom silicon deals to be the next real catalyst pushing this stock toward where the analyst community already believes it belongs. So why own all four of these together in the same portfolio? At first glance, they don't even look like they belong anywhere near each other. One tracks the price of gold sitting in a vault somewhere. One is building enterprise software for governments, hospitals, and energy companies. One is quietly powering the devices already sitting in your pocket and parked in your driveway. And one dominates the chips currently training the world's most advanced AI models. But that's exactly the point of building it this way. Each of these four positions benefits from a completely different environment. If inflation stays sticky and interest rates eventually start coming down, the gold miners could have their moment in the sun. If enterprises keep adopting AI directly into their day-to-day operations, Palantir benefits from that shift. If computing keeps moving toward the edge and away from centralized cloud data centers, Qualcomm wins from that trend. And if the AI infrastructure build-out keeps accelerating the way it has for the past few years, Nvidia keeps compounding right alongside it. I'm not trying to guess exactly what happens next month because, honestly, nobody can do that consistently. I'm building around several different outcomes happening at once because nobody, including me, truly knows exactly how the next 12 months play out for the broader market. The biggest mistake I see everyday investors make over and over again is assuming that every single pullback is a warning sign instead of recognizing it as an opportunity. Sometimes the market is simply handing patient investors a better price on businesses that genuinely haven't gotten any worse. That's exactly how I'm choosing to treat these four opportunities right now. And it's a mindset I'd encourage you to sit with the next time your portfolio has a rough week. None of this means buying blindly or ignoring position sizing. Even the strongest long-terms thesis can go through painful stretches along the way. And every one of these four names carries its own risks worth understanding before you put real money behind it. But understanding the risk is different from being paralyzed by it, and that distinction is where I think a lot of investors lose their edge during moments exactly like this one. If you found this breakdown helpful, make sure you're subscribed here on Ticker Hawk so you don't miss next week's picks, because I'm covering names most other channels aren't even looking at yet. Drop a comment letting me know which of these four you're most interested in adding to your own portfolio this year, and which one you think has the biggest chance of surprising everybody in the back half of 2026. Share this video with another investor who's been sitting on the sidelines waiting for a better entry point, because honestly, this might be exactly the setup they've been waiting for. Thanks so much for watching, and I'll see you in the next one.